Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Good morning, everyone. This is John Darsie, your editor-in-chief, here to bring you the morning call. So this morning we come in, futures are up slightly as this Cyprus situation remains in focus. There's still no resolution to what their bailout is going to be, what it's going to look like. You had Russia, who is a potential, they were going to have potential involvement in a bailout, but they have sort of rejected taking the leadership role on that. So it's still a situation that's in flux, and it's something that we'll keep an eye on over the next few hours. And they want to get resolution to it today. Either the ECB is taking a very strong stance on what they're going to allow the terms of the bailout to be, sort of putting their foot down finally, maybe using a smaller country as their guinea pig sort of for taking that harder line. But it's something to keep an eye on definitely as we see whether their banking system is going to basically become insolvent. But right now the market doesn't seem to be all that worried about it. Yesterday, I guess 2 days ago, you come in, the market is bouncing and you're saying, oh, so the markets have completely put Cyprus off to the side. Those are the headlines. And then we come in yesterday and the markets sell off and everyone's saying everyone's worried about Cyprus again. So I mean, it's just back and forth about, are we worried about Cyprus or do we not care about Cyprus? But I think right now you just pay attention to the price action and don't worry so much about the headlines. And I think as Scott has said several times in his notes and his videos and stuff in the last few days, is that there's times as a trader where less is more. You don't always have to be all in or all out of the market. You don't always have to be super active trading. If there's erratic price action, if there's headlines driving the tape, take a step back, sit on your hands a little bit, and wait for things to be more calculated and more clearly set up from a technical perspective. From a stock-specific perspective, we have seen several red flags over the last week, few days, that tell you that we could get more downside and a deeper correction this time around. But it feels like every time we've said that and pointed out red flags and erratic action, all we've done is just shrug off the bad news and continue to bounce. So we'll go ahead and take a look at the spider chart. Or first the S&P chart, just to give you a shot of that index, is that we have important pivot support right here around 1539, which 1538, 1539, which is that pivot that coincides with the 21-day moving average. We're just below the 8-day, and this morning we're not up enough to take us back above it, I don't think. So that'll be important to watch, whether we get rejected at that 8-day moving average or whether we can push back above it. And if we do get more downside, that 21-day moving average will be important to watch. And then you'll have this prior breakout level that stands around 1530 that would also be important support that traders would be watching closely to see whether we just get a retest of that level or whether we break below and perhaps test the 50-day or even this lower pivot. But based on the price action right now, we've been able to shrug off this Cyprus news, and the market doesn't seem to think it's that big of a deal yet. And maybe they have faith that no country is going to leave the Eurozone. They're going to figure something out in the end, but we'll see, and let the price action do the talking for you here. A couple of the red flags that I mentioned, one of the major ones is the financials, which you've seen. The financials have been one of the strongest sectors in the market over the last year. You see this firm uptrend in the XLF that still has yet to break, but we've seen a few stocks within the sector show some weakness and really start to show some technical damage. Like I said, the XLF is still in that uptrend, but you're seeing it test its 21-day moving average yesterday, show relative weakness to the market, and it looks like, in my opinion, we could test that 50-day, which still wouldn't mark a break of that downtrend yet, but I think we could get to the lower end of that channel and potentially see what could happen here with the XLF. One of the stocks I was talking about, we've seen a lot of divergences within the sector, which a lot of times you talk about sector rotation in the market and divergences between sectors, is that you also can get a lot of divergence within sectors at times, and that's sort of what we're seeing within the financials right now. And a lot of it's based on their exposure to Europe and the European banking system and the European debt crisis, is that you're seeing a stock like Goldman Sachs, which is highly exposed to Europe, show a lot more weakness based on that Cyprus news. So if we go back to the chart, you see the technical damage adding up in Goldman Sachs. One thing in the active trader course that we talk about is moving averages, which way they're curling. And right now you have the 8 and 21 days starting to curl down in Goldman Sachs after this choppy action near highs. And you saw it lose its 50-day moving average yesterday, which, and we also looked to see how, how fierce or how intense the close below that 50-day moving average is when it happens. And yesterday we saw a very definitive close below that 50-day moving average, not just a slight close below or, it bounced off its lows into the close and is just below the moving average. It accelerated through that 50-day moving average and closed on its lows, which is a very bearish sign for that stock. And there's not a whole lot of support here on this run up here in Goldman Sachs, so I would definitely keep an eye on that to see if we get more damage, because that could be a major tell for the market. Another one that looks a little bit better but is teetering sort of near upper level support is Morgan Stanley. It's held up a little bit better than Goldman in the last couple days after we saw on Tuesday this sharp sell-off in Morgan Stanley. But this is an obvious upper level floor with a gap to keep an eye on. And it feels to me like we probably could get a gap fill in Morgan Stanley here down into this gap that would close at around 2075. Definitely keep an eye on that as something that could weaken. It's another bank that hasn't been acting well. If you want to look on the flip side of it, look at Bank of America. That's the one Scott has been playing and talking about. The Fed did a test of everyone's capital plans, all the banks' capital plans, and Bank of America passed with flying colors. And they're returning cash to shareholders with a $5 billion share buyback. They're redeeming $5.5 billion in preferred stock. It's above all of its moving averages, and was a little bit weak yesterday with the rest of the banking sector, but all in all, it's holding up extremely well. And it's one that if you're looking to play long to the banks, it looks like Bank of America is the one you want to be looking at right now. Another red flag we saw yesterday was in the IYT, the transports ETF, which the transports have been leading this market higher over the last few weeks, for most of this year, in fact. And Dow theorists point to that as a very bullish sign, a sign that the economy and the market potentially have more upside. But if we do start to see the transports weaken, it also could be a red flag that maybe the market and the economy are starting to perhaps stall out a little bit. We don't have a ton of evidence of that in the economy, but perhaps look at the next few economic reports to come through, the next jobs report, the next ISM, that type of stuff, to see whether we do get some confirmation if we do get continued weakness in the transports. And one of the big reasons the transports was so weak yesterday and tested that 21-day moving average was FedEx, which itself is a major barometer for the economy, because an economy that is moving quickly and is very healthy, you're going to see a lot of shipping, and that's a very primitive way to look at it, but it's a very easy way to get a tell on an economy. And yesterday we got even further downside in FedEx. You see this gap down, you say, okay, FedEx, how are you going to treat that gap down? It didn't bounce into the gap at all, continued lower, and then yesterday, the same thing, had a very harsh down day, down into the 200-day moving average. It'll be very important to watch that 200-day moving average to see whether we get more downside in FedEx, because if we do, that would be a major complexion change and a huge red flag for the market. Right now, it's just sort of the market is trying to quarantine it as best it can, but we'll see what that leads to in the broader markets to see the transports and specifically FedEx show so much weakness. We'll take a look at Apple, the tech stock that everyone loves to talk about, former market leader that has been terribly weak over the last 6 months after topping out above $700 a share. And we talked last week about how that Samsung event could be a buy the news opportunity for Apple, and that's what it turned into. Whether it be because the Samsung phone wasn't that impressive or Apple just needed to get that news out of the way. You saw a nice bounce, and although Apple has been a little bit lackluster the last few days, you have it above its 8 and 21-day moving averages. It's found a little bit of resistance at its 50-day, but I think after a bounce to break that downtrend, I think it's healthy to see Apple hold up, consolidate, show a little bit of relative strength to the market yesterday, and I think this is definitely a pattern that's coiling for a bigger move. So I would watch this pivot right here. If we we have this tiny little range, I'll zoom in a little bit just so we get a better look at it. We have this tiny range here that You can use 460, basically 461 as a pivot high, and the 50-day moving average. If we can break above that, we could get some momentum. And then you also have this little pivot here. The high on that bar is 484.94, so about 485 is another pivot. But I do eventually think we'll get a gap fill here up to about the 514, 510, 514 level. And then eventually, I do think Apple will bounce and test that 200-day moving average, and basically traders will reevaluate the situation with Apple once we get to that point. Apple's not one right now that you can probably put in the drawer and trust a ton because of the weakness that we've seen over the last 6 months and the concerns with diminishing margins and diminishing sales of their iPhone, which is really what drives the stock and drives the company's revenues, but it's definitely something to keep an eye on. One yesterday that a lot of guys on the virtual trading floor were trading was Hewlett-Packard. That's a little bit on a different side of things than people have been focusing during this rally in 2013, but as the market starts to show some erratic action and some red flags, maybe you do look for a couple shorts, stocks that have run a long way and perhaps due for a pullback or a rest. And like I said, we got a red dog reversal in Hewlett-Packard on Wednesday as we traded up through the previous day's high after a rally and then closed back below to put in that kind of topping tail. And then you had some guys hold that short, with that risk parameter at the high of this bar. That's how a red dog reversal works. And then you saw a continuation of the downside yesterday into the 8-day moving average, and it'll be something to continue to keep an eye on about whether perhaps Hewlett-Packard does maybe test its 21-day and get more downside. But I think an interesting note here is we're going to do a little lesson from the active trader course about time frame continuity. And it's something that also Rob Smith focuses on a lot in his course and in his mentoring room. Is that you look at Hewlett-Packard and you say, oh wow, it's been very strong in 2013, a nice bounce. But if you look at the longer time frame, I'm zooming out to the weekly here and then zooming out even further, the trend is to the downside in Hewlett-Packard. So according to what we teach in the active trader course and what Rob Smith teaches in his room, is that you always want to look to develop trade ideas on the side of the longer term trend. And so you see Hewlett-Packard, obviously the longer term trend is to the downside. Yes, it was able to break this accelerated downtrend that started basically at the beginning of 2012. In 2013, it's been impressive, but you still, if you draw your lines, you still have a downtrend in place from early 2010 that Hewlett-Packard's not even close to breaking. So this is why potentially, we say don't short strong stocks, especially after big runs. You don't necessarily blindly look to short stocks. If you're going to do that, look for a calculated setup. Look for a red dog reversal type play where you have defined risk, and look to do that in a stock that the longer term trend is to the downside. So that's what a lot of people saw in Hewlett-Packard and got a nice trade out of it. We'll take a look at DDD, which is another one that people have been focusing on the last few days as the market has been a bit lackluster. It's take a more stock-specific approach and look for the stocks that are moving and providing momentum. We'll go back to the daily chart here in DDD, and it's sort of been waffling back and forth here around its 200-day moving average. And yesterday you saw a nice definitive break back above that level. So now traders will be watching to see whether DDD can put in a base and consolidate above that 200-day and perhaps set the stage for a bigger bounce, maybe back into the 21-day MA. Who knows? But this is a hot sector that was on a huge run over the last few years as 3D printing starts to become the new hot technology, sort of. And this is one that I know Mark Sperling focuses on and likes to buy the dips in these 3D printing stocks. I know he's playing DDD with some options and with some common stock. And I know Mike Lee and Steve LeVay focus very heavily on Triple D in their momentum mentoring room, as it obviously provides great momentum, great ranges. With that 3-for-2 stock split, it's even a cheaper stock, so it makes some people more comfortable trading it. But it's definitely one that if you're actively trading, watch DDD, pay attention to those guys in their mentoring rooms to get a feel for how they're trading it. A couple more we'll take a look at. YHOO got upgraded yesterday. This is one that's among Scott's long positions, and the stock has been on a tremendous run since September, and a lot of that you have to give credit to Marissa Mayer, the new CEO who came over from Google, who's very well respected and talented executive, and she sort of cracked the whip over there. No more working from home with YHOO. Everybody's got to get in the office, they got to innovate, they got to incubate new ideas, and the stock has responded in kind to her new leadership. And yesterday, like I said, it got upgraded, had a nice descending channel that you can measure a trade out of, and now it's back above all of its moving averages, above the 8-day, and look at that pivot high to see if we get some momentum above that level. We might rest a little bit today as the market waits for resolution on the Cyprus situation, but I think next week, if the market does cooperate, YHOO is one to keep an eye on for a breakout above this pivot high, which is around 23.10. Another one, CRM, is another one to take a look at that has a similar type of, and an even steeper descending channel. Yesterday after the close, CRM, Salesforce.com announced a 4-for-1 stock split, I believe. So they're really going to try to make this a lot cheaper stock and bring in a different class of investors. So it'll be important to see today how CRM reacts to that news about whether we do get a break above that steep descending channel, or whether the stock split isn't something that's that exciting for investors, and whether it gets shrugged off. But a lot of times you do see stocks tick up on the announcement of a stock split, so definitely something to keep an eye on today. A couple weaker tech stocks that I would definitely keep an eye on. Amazon has been weakening significantly, broke below its upper floor here. Looks like it wants to test its 200-day, which would also coincide with this little pivot support. So definitely, it might be a little bit harder to short Amazon after the sell-off we've gotten over the past couple weeks, but it's definitely one that I think is weaker, and that, if you're looking to short tech stocks or short stocks on balances, I think Amazon is one you can definitely look at. And I think Netflix is one that hasn't been quite as weak, but it feels to me like it's just holding up by a string at this upper level support. Is that you have the 8 and 21 day starting to curl down a little bit. You've had 100% move basically since earnings for Netflix, and I think some of the short covering part of this move is over, and I think it's starting to get a little bit exhausted, and I think it's sort of teetering on the edge. I know Laz is short in Netflix in the virtual trading floor. I think it's definitely one that, if you're looking for a trade that has a little bit more meat still on the bone rather than one like Amazon as a short, I think you could probably look to Netflix and maybe get some downside. You could perhaps see Netflix get back down into its 50-day moving average. It's around there, around 164. Another one we're going to look at as the new phone comes on sale today is BlackBerry. The new, I believe it's the Z10, goes on sale today, and so we'll be looking for anecdotes and news about how well those sales are going on that phone that could perhaps drive the action of this stock. But I know Mark Sperling is short BBRY, and it's one that, just like I talked about with Hewlett-Packard, BBRY has been very strong since September. It's been strong since it got a new name. Research in Motion changed the symbol from RIMM to BBRY, and it seems like maybe psychologically that helped the stock, because RIM had been just a huge dog of the market. We'll zoom out and take a look at what's happened with that, just to make the point of the longer-term trend. The longer-term trend, obviously, the stock topped out above $140 a share. It's now trading around 16. I got a nice bounce if you're looking for a trade there, but I think BlackBerry Research in Motion is a dying brand, even if they did freshen up their lineup a little bit with these new phones. But I would be much more inclined to short this stock on balances because of the long-term trend than I would be to look for continuation to the upside after buying a big dip. A couple people in the virtual trading floor wanted me to look at a couple things. Boeing is a stock that had a very impressive breakout after Scott listed it on his 2013 predictions. Very clean move there. It even almost hit his target for the year with some nice percentage gains. So maybe it's time to pare back your expectations and trim some of that position. But I think there's not a lot of support here. You have this little pivot that could provide support if we even do retrace that much on Boeing. But this is one where if you don't see a lot of support as a way to gauge a pullback after a breakout in a stock, what you want to do is use your Fibonacci retracement tools. So we'll see if we can find that. We've got a Fibonacci retracement right there. We measure that from the breakout level right here up to here. We make it so we can see it. And then I'll zoom in here. A little bit hard to see there. There we go. So you have the Fibonacci retracement tool. What you really want to see on a breakout with a stock like Boeing is you want to see the stock hold that 50% retracement level from the breakout. So we're still above the 38.2% retracement level, which is very healthy. I would watch these Fibonacci lines and measure on your chart using these Fibonacci tools. potentially use that as your gauge as the health of the breakout in Boeing and about whether it can get more upside. And if we do get a retest of that 50% retracement and bounce off of it, maybe that's your signal to potentially buy the small dip in Boeing for a potential bigger move as the Dreamliner finally gets off the ground. Sorry for the pun. And GLW is a stock that I have been talking a lot about on Twitter, sharing some articles and sharing some of my opinions on that. And we'll go back to the daily chart. We can see the pattern more clearly. It had a nice breakout above that $13 level on Wednesday, but yesterday, amid the market weakness, we had a pullback to that $13 level. But we have the moving averages curling up. You have a compelling story with Corning with their Gorilla Glass. Their core business is sort of the LED and LCD displays, and they have a lot of joint ventures with companies like Dow, Samsung, and they're starting to innovate with that Gorilla Glass, and Gorilla Glass is starting to get more popular and be used in more displays and more screens on iPhones and iPads and things like that. And that's really going to be the growth engine for this stock that has become a little bit of a value dinosaur over the last several years. But like I said, Gorilla Glass is the real growth story there. You see a gap up here in Corning. It basically filled that gap Wednesday, but I think you have this pivot high here that if you're looking to only swing trade this, I think your target could be up in that $14 area. And maybe you could even add on that retest yesterday. But longer term, I think Corning can have a lot more room. You zoom out and you see where this stock came from, and it was a $24 stock as recently as 2011. They've seen margins and stuff diminish on their LCD LED business, but I think all that stuff is a little bit overdone to the downside. And I think if you're looking to put a stock in the drawer, I think this is a very compelling one. It's got about a 3% dividend yield, so from a value perspective, it's very attractive also. But I think if you're looking for a longer term play, I really like Corning, and for full disclosure, I own it in my IRA. I recently bought it, and it's one that I'm going to look to hold on a long-term time horizon. Talking about value stocks, we're also going to take a peek at just a couple stocks that I noted looking around at charts yesterday. Is that we've seen these value dividend type stocks, the very safe stocks that people play when they're looking for some safety, and we have seen a big flight to safety, I think, and these charts are evidence of it, and evidence that people are still a little bit jittery about playing growth stocks and playing growth sectors after the financial crisis, and I think there's still some scars there, so people are looking to play these dividend value stocks. First one we're going to take a look at is Coca-Cola. If we zoom back in, you can see from 2010, if you're looking to buy dips in these types of stocks, we could even zoom out further and see from financial crisis lows about how far Coca-Cola has come as a stock that pays a huge dividend. What a buying opportunity that was back in 2009 in Coca-Cola around the $20 area. You've doubled the stock, a stock that pays a tremendous dividend. What a great story there for investors. This is a great play. One of Warren Buffett's great, one of his biggest components in his Berkshire Hathaway, one of his favorite stocks. And technically, you start to see Coca-Cola coming up to this pivot high and potentially looking to break out. Momentum traders don't look for a stock like Coca-Cola for momentum breakouts, but if you're a swing trader looking for a stock that's breaking out and you like to have a dividend and stuff like that, and you're looking for a longer term hold, I think Coca-Cola is enormously attractive right here. That's on the weekly chart. You go back to the daily, you can see it a little bit as well. Coming back into that pivot. Another one is Kellogg's, which has had an enormous move just since last August. The stock rallied from about the $46 level. Yesterday closed around 62, 63. What a huge move for a stock that pays a very healthy dividend. This is just evidence of that flight to safety and something that you should definitely keep an eye on. And if that's your approach to the market, you're probably extremely happy right now playing those lower risk, high yield safety stocks. We'll just take a look at a couple more just to look at them. Procter & Gamble is a perennial dividend play, value play. It's sort of flagging up here, sort of like Coca-Cola. You don't look a lot of times for a stock like Procter & Gamble for momentum breakouts, but it is flagging, and it looks like you could get more upside in a stock like Procter & Gamble that pays a very healthy dividend as well. Then Johnson & Johnson. There's some news about Johnson & Johnson this morning as it looks to maybe acquire I believe a Botox company or something like that. But another really big move in a stock that is supposed to be just a dinosaur that trades in a range and pays you a dividend and stuff like that. But this is just evidence that even if you do play these safe dividend type stocks, you can get growth and you can get some really nice returns off these at a low risk that allows you to really sleep better at night. Well, that'll about do it for today's morning call. March Madness, maybe volume be a little bit lighter today as people watch the games. A lot of great games yesterday. It's great to see a school like Harvard, with their kids that are held to a high academic standard. It's great to see them win an NCAA tournament game and really play well. And just the magic of March Madness. This is one of my favorite times a year. Really enjoyable to watch all those games during the day. This first weekend is perhaps my favorite sports weekend of the year. So in the afternoon, maybe sneak off and watch those games a little bit, enjoy yourself, as this market is erratic and sitting on your hands, and taking that less is more approach might be prudent and give you an excuse to go enjoy some great college basketball. But that's John Darsie for your daily recap. We'll see you in the virtual trading floor, and we'll see you Monday on the morning call.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.